I want you to take a second and just picture the cloud.
Right.
And I don't mean the meteorological kind. I mean the digital one.
Yeah, the one we all use.
Exactly. When you think about where your digital life actually lives, or, where the artificial intelligence you use every single day exists.
The tech industry has really trained us to picture something totally ethereal.
Yes. Something completely weightless.
Yeah.
We imagine this invisible data just sort of floating silently in the ether somewhere.
Right, because the branding implies it's just clean. It's infinite. It operates almost like magic.
Like magic. But it's actually, it is arguably one of the most brilliant marketing metaphors ever devised.
Oh, absolutely. By calling it the cloud, we are psychologically encouraged to believe our digital footprint has, well, absolutely zero physical weight in the real world.
Right. But today, we are taking that whole ethereal image and we're pulling it right out of the sky. We're dropping it hard onto the ground.
Because when you strip away that branding, it's not vapor.
No, it's not. It is made of millions of tons of poured concrete. It's constructed from, thousands of miles of heavy copper wire. It is powered by these roaring multi-story combined cycle gas turbines.
And consuming millions of liters of local groundwater every single day.
Exactly. And increasingly, it's entirely reliant on radioactive nuclear fuel rods.
We're currently living through the heaviest, most intensely physical infrastructure build-out the world has seen in generations.
Which is wild to think about. So, welcome to this deep dive. Our mission today is fundamentally different from the usual tech conversation you might hear.
Yeah, we aren't analyzing software updates today.
Right. We aren't looking at the stock prices of AI startups. We aren't even debating the philosophical implications of artificial general intelligence.
We are exploring the uncompromising raw physical reality of this AI boom.
Yes, we're diving into this fascinating structural analysis. It's a view from the East, actually. It looks at what happens when these boundless digital ambitions suddenly just crash headfirst into hard thermodynamic reality.
And we really need to set some ground rules for you right at the start.
Definitely.
Because the framework we are using today is designed as a totally open exploration.
Right, there are no endpoints here.
Exactly. We are deliberately stepping away from firm conclusions. We're not here to declare that the AI industry is this inevitable bubble destined to crash.
Nor are we here to confirm it's going to smoothly conquer the global economy.
The goal today is simply to ask better questions.
Better questions, yes. And to look at the physical blind spots of this revolution. We want to look at multiple angles. So, to set up this journey, we have to differentiate between how the world processes a financial correction versus a physical one.
This is a crucial distinction.
Right. If we look at the financial and market structures, the venture capital, the stock valuations, revenue projections.
Spreadsheets.
Exactly, the spreadsheets. We can call those priority 1 and 2.
Right.
And when a correction happens in that space, it's undeniably painful for investors, right?
Right.
But it resolves with incredible speed.
A stock can reprice in literally a millisecond.
Yes. A massive tech company can completely pivot its business model in a matter of quarters. The capital is fluid, the losses are written off, and the market just moves on.
Because the financial world clears quickly. It operates on ledgers and sentiment.
Right.
But the focus of our exploration today is what happens when that capital pile stops being purely financial and solidifies into physical assets.
We are entering priority 3.
Yes, priority 3. This is where the venture capital transforms into structural steel.
Right.
Into high voltage transformers, into industrial cooling towers. And the core tension we need to unravel here is this. Physical things do not reprice in a millisecond.
No, they do not.
You simply cannot pivot a 1 gigawatt gas turbine on an afternoon earnings call.
You just can't. If a correction happens in the physical realm, it doesn't clear in a financial quarter. It gets stuck.
It clears over a generation.
Decades. These massive assets just sit there for 30 or 40 years, humming, consuming maintenance budgets, and relentlessly demanding that their debt be serviced.
And to truly comprehend why a physical correction is so vastly different and potentially so much more dangerous than a financial one, we have to grasp the jaw-dropping scale of what is currently being permitted and financed.
The numbers are staggering.
They really are. And unless you are actively reading heavy industry and energy trade publications, this build-out is happening largely out of sight.
So let's lay out the baseline for you. Right now, total data center power demand in the U.S. sits roughly around 30 to 40 gigawatts.
And that baseline took decades to build.
Decades. It encompasses everything from the early internet infrastructure to the massive shift toward cloud computing over the last 15 years.
It is a massive footprint.
But by 2030, which, let's be honest, is barely a blink of an eye in infrastructure time regress, AI adoption models project this demand will hit roughly 80 gigawatts.
Those potentially soar over 100 gigawatts.
Which is insane. We need to contextualize that 80 gigawatt figure because, gigawatt is one of those terms thrown around in sci-fi movies.
Yeah, it sounds abstract, like Back to the Future.
Right. But an 80 gigawatt expansion is not a minor incremental upgrade to the national grid.
No, it is the equivalent of adding the total maximum output of 80 large-scale nuclear reactors.
Right.
Or if you prefer natural gas, it represents the output of roughly 160 massive combined cycle gas power plants.
Added in under a decade.
So
we are talking about grafting an entirely new parallel civilization's worth of power consumption onto the existing grid.
And the bottleneck isn't just generating the electricity.
Right.
It's the sheer physics of moving it from where it's created to where the data centers actually sit.
The transmission.
Exactly, the industry-commonless transmission. You can't always just drop a gigawatt-scale data center right next to a hydroelectric dam.
Obviously not. These facilities are sited based on a really complex web of variables, where the major fiber optic trunks intersect, where the land is cheapest.
And crucially, where local municipalities have offered the most aggressive tax incentives.
Right. So because generation and consumption are decoupled geographically, you have to build new high-voltage transmission lines to bridge that gap.
You need to construct massive new substations equipped with highly specialized, custom-built transformers.
And the timeline for this in the United States is just grueling.
Permitting and building a new high-voltage transmission corridor typically takes between 5 and 10 years.
Just to permit and build it. Think about what that entails. You have to conduct multi-year environmental impact studies.
Yeah.
You have to secure rights-of-way across hundreds of miles of private property.
Which often requires eminent domain battles.
Exactly. You face intense, highly organized local opposition from communities who don't want massive steel towers bisecting their towns.
And you have to navigate this labyrinth of state and federal regulatory approvals.
Getting the wire in the sky is a monumental, decade-long bureaucratic and engineering ordeal.
And this geographical friction sets up our first massive temporal paradox. The infrastructure that energy companies and tech giants are fighting to permit today, attempting to meet the projected AI demand for 2025 and 2026, will not actually be energized and operational until somewhere between 2030 and 2035.
Okay, let's unpack this.
Yeah.
It's like deciding you need to build a sprawling coast-to-coast interstate highway system by next Tuesday.
Right.
But you are well aware that by the time you actually finish pouring the asphalt in 10 years, you have no idea if people will still be driving cars, or if they will have shifted to flying hovercrafts.
Or if they'll have stopped commuting entirely.
Exactly.
That analogy captures the risk perfectly. By 2035, the AI landscape will be entirely unrecognizable.
Totally.
The underlying architectures will have iterated through multiple generations. The physical demands of the hardware might be completely different.
We might see a shift toward smaller, decentralized processing.
Or highly specialized local nodes. Yet, we are locking in the physical pathways for massive centralized energy consumption based entirely on the assumptions of today.
And we should emphasize that this is a global frenzy. We aren't just talking about Virginia or Texas here.
No, it's everywhere.
The UK is actively looking at fast-tracking data center approvals to capture the market. Meanwhile, in Ireland, the grid in Dublin is so thoroughly overwhelmed by existing data centers that there is a de facto moratorium on new connections.
They physically cannot absorb the load without risking grid stability for residential areas.
Right, but the global capital keeps hunting for locations anyway. The Gulf states are marshaling their sovereign wealth funds to build gigawatt-scale AI campuses straight out of the desert.
India is planning massive data center corridors. Southeast Asia is in an absolute frenzy of infrastructure planning.
So this global context really frames the open exploration we are navigating today.
We have to continually ask, how does a society reconcile building rigid, decade-long transmission lines for a technology whose core architecture and demand profile completely mutates every 6 to 12 months?
It's a huge question. And the friction between those two realities leads us directly into the mechanics of how this is all paid for.
The financing trap.
Yeah. If this were just a software company that overhired or a hardware manufacturer that built too many smartphones, the solution would be straightforward.
The company takes a massive write-down.
Right. Investors lose their shirts, The stock price tanks, the assets are liquidated, and the economy absorbs the blow and moves forward.
But you cannot simply write down a specialized electrical substation.
Or a massive natural gas pipeline.
Yeah.
The assets are stuck because of the unique way physical infrastructure is financed.
It is a completely different universe than venture capital.
Completely.
In the financial markets, capital is liquid and risk is priced dynamically. But energy and municipal infrastructure are financed through mechanisms that are inherently illiquid.
And more importantly, they are deeply structurally embedded in the political system.
They are designed to be permanent.
So let's map out exactly how this works, because the mechanics here are fascinating. Let's look at utility rate-based regulation. Say a massive utility company needs to build a new $2 billion combined cycle gas plant just to handle the load of a proposed AI mega campus in their state.
They don't just use cash from a checking account for that.
No. What is the actual process they go through?
So the utility has to initiate what is known as a rate case.
A rate case.
Right. They go before their state's Public Utilities Commission, which is a regulatory body, and they present their projections. They say, look at this projected AI demand. If we don't build this $2 billion plant, the grid will fail. We need authorization to construct this asset.
Okay, so if the state commission agrees and approves the project, that $2 billion expenditure is officially placed into what is called the utilities rate base.
Yes. And the rate base is the crucial concept here. Once that plan is categorized as part of the rate base, it unlocks a very specific financial mechanism for the utility company.
Which is?
Once an asset is in the rate base, the utility is legally entitled to recover the entire cost of that asset directly from the monthly power bills of all their customers.
Wow.
But it's not just recovering the principal. They are also guaranteed a regulated return on equity.
Like guaranteed profit.
Exactly, typically somewhere between 9 and 11%. And they collect this guaranteed return over the entire depreciable life of the asset.
Which is usually 30 to 40 years.
Yes.
So I want you to think about this for a second. We need to be incredibly clear about what that means for you, the everyday person listening to this.
A guaranteed profit margin for a multi-billion-dollar industrial facility is being structurally baked into the monthly energy bills of ordinary citizens.
Small businesses, local schools.
Stretching decades into the future.
It is arguably one of the most stable yet politically sticky forms of infrastructure finance ever created.
Right. It was originally designed a century ago to incentivize utilities to electrify rural America, guaranteeing them a return so they would build power lines out to distant farms.
But when that same mechanism is applied to hyper-volatile AI infrastructure,
the risk profile changes completely.
Because once that rate case is approved and the concrete is poured, the financial gears are locked in place.
The municipal bonds are sold to investors.
The construction unions have signed their contracts.
The natural gas suppliers have inked 20-year delivery agreements.
And the local government has already baked the projected property taxes into their civic budgets.
And here's the trap.
Okay.
Let's imagine a scenario 4 years from now. The AI company that requested all this power experiences a massive breakthrough in algorithm efficiency.
Oh, right. Like they suddenly figure out how to do the exact same amount of computation using 80% less power.
Or perhaps the AI bubble simply cools and the company halts its expansion.
The tech company can pivot instantly.
But what happens to the utility?
The $2 billion plant is already built. It's sitting there running at 20% capacity.
Yeah.
Can the utility just, like, undo the rate base?
Unwinding a rate-based asset under those conditions requires political and legal maneuvers that border on the impossible.
I can imagine.
The State Utilities Commission would have to publicly admit they made a multi-billion-dollar forecasting error.
Which politicians love doing.
Exactly. And the utility company would fight tooth and nail because their legally guaranteed 10% profit is on the line.
They'd have to break union agreements, legally restructure complex bonds.
You would have politicians forced to stand in front of their constituents and explain why residential electricity bills are still astronomically high just to pay off a data center that is currently sitting half empty.
And employing almost nobody.
Right. The political system is designed to avoid that exact kind of acute embarrassment.
So they don't unwind it.
No, they litigate it, they hold endless hearings, they stretch the failure out over a decade of bureaucratic proceedings.
But during that entire lost decade, the debt remains.
The ratepayers are still paying?
It creates what economists call a massive deadweight loss.
Yes. The productive economic return on the physical asset has plummeted, but the financial obligations required to maintain it remain absolute.
So society is forced to just pour capital into a black hole of obsolete infrastructure.
And the financial entanglement doesn't stop with the utilities either. We have to look at the municipal side.
Right, the local governments. Because many of these massive data center campuses are heavily backed by local economic development authorities.
A county government will issue municipal revenue bonds to pay for the roads, the water lines, the sewer upgrades necessary to support the facility.
And they issue these bonds relying entirely on the projected property tax revenue or the long-term lease payments promised by the AI tenant.
And the premise of municipal bonds is that they are generally very safe, predictable investments.
Right.
So because of that perceived safety, they are primarily purchased by massive institutional pools of capital. We are talking about state pension funds,
Teachers' retirement accounts.
insurance companies, retail investors looking for steady yield.
Okay, so think about this for a second. If a massive AI data center goes bust, the debt doesn't just disappear into the cloud. It lands in someone's lap.
It lands forcefully in the lap of the local municipality.
The bond payments are still due. If the tax revenue from the data center isn't there, the local government has to find the money somewhere else.
They have to start cutting local school budgets.
Delaying road maintenance, freezing hiring for emergency services, or just raising property taxes on local residents.
We are essentially taking the extreme high variance volatility of tech startup revenue projections and hardwiring it into the foundational budgets of local towns.
Are we basically putting municipal budgets and pension funds on the roulette table based on chatbot revenue projections?
It really looks that way, and the vulnerability extends deeply into private capital markets as well.
Through PPAs, right?
Yes, power purchase agreements or PPAs.
Yeah.
When a data center operator wants to guarantee their energy supply, they will sign a 15 to 20-year PPA with an energy generator.
Agreeing to buy electricity at a fixed price.
Exactly. Then the generator takes that ironclad 20-year contract to a bank or a private credit fund and uses it as collateral.
To secure the hundreds of millions of dollars in loans needed to physically build the power plant in the first place.
Right. The contract itself is the collateral.
So if the AI operator eventually defaults on that PPA, or they find some legal loophole to exit the contract because they no longer need the power.
The entire financial stack collapses.
Wow.
The energy generator is suddenly stuck holding a massive, expensive power plant built specifically for a customer that vanished.
And the lenders, who, by the way, are often managing money for university endowments and sovereign wealth funds, are left holding massive, non-performing loans.
And unlike a bad stock pick, you cannot just log on to a brokerage app and sell a non-performing loan for a half-built rural power plant.
The capital is completely, utterly frozen in concrete and steel.
The lenders are forced into years of complex bilateral legal negotiations to try and restructure the debt, while the asset itself just degrades.
So this forces us to ask, what happens to a local economy when it is forced to service a 30-year debt for a technological ghost town?
It's a fantastic open question.
Which brings up a fascinating secondary dilemma. Let's say we avoid a catastrophic crash.
Okay, a soft landing.
Right. Let's say AI demand just normalizes. It grows at a respectable 10% instead of a hyper-growth 30%. The models get smaller, operations consolidate, and suddenly the tech companies realize they don't need all these massive premium facilities.
This introduces what the source text calls the cathedral problem.
Yes. Let's talk about the physical building itself, because the physical architecture of these new AI data centers is entirely bespoke.
They are not just big warehouses with standard servers.
No, they are engineered to handle extreme densities of power and heat.
They have reinforced floors to handle the immense weight of specialized AI server racks.
They have complex, incredibly expensive liquid cooling loops built directly into the architecture. They are engineered to a standard that simply didn't exist 10 years ago.
So we are spending hundreds of billions of dollars to build state-of-the-art, hyper-specialized cathedrals.
Here's where it gets really interesting. What do you do with a half-empty cathedral?
If the market decides it only wants a chapel.
Exactly. I mean, the most obvious answer you'd hear from a tech executive is, well, we just repurpose the space. We'll use it for general cloud computing.
We'll run standard web hosting, enterprise software, typical data storage.
The building is there, the power is hooked up, the fiber is laid. It seems perfectly logical, right?
From a purely engineering standpoint, sure, it is logical. You can absolutely run standard workloads in an AI data center.
Uh,
But from a financial standpoint, it is a disaster.
why?
Because the margins for general cloud computing are vastly different from the margins for cutting-edge AI inference. The
Ah.
infrastructure was permitted, financed, and built expecting to capture the massive premium that AI commands.
Right. So to use a hypothetical baseline, imagine the facility was financed on the expectation that it would generate, say, $2 of revenue per watt of power consumed by running complex AI models.
Right, $2 a watt. But the general cloud computing, market hosting, standard websites, and company databases is a brutal, highly commoditized race to the bottom.
In that market, you might only generate 15 cents of revenue per watt.
You are putting a 15-cent workload into a facility built for a $2 workload.
The physical asset hasn't changed, but the revenue stream has collapsed by an order of magnitude.
And the fatal flaw is that the debt structure, the utility rate base, and the municipal bond payments were all sized based on that $2 expectation.
You've bought a custom-built Ferrari. The market has decided it only wants to pay you taxi fares, but the bank still absolutely requires the monthly Ferrari payments.
It's a structural impossibility.
Right. Well, what about even lower value workloads?
Like what?
You could offer the space to massive rendering farms for Hollywood visual effects, or lease it out for academic scientific computing, or even crypto mining.
You could, but those industries operate on razor-thin margins or are entirely reliant on institutional grant money.
So they can't pay the Ferrari prices either.
They can never generate the capital necessary to justify or service the debt of the premium infrastructure that was originally built.
Okay, so if you can't run high-margin workloads, and the low-margin workloads don't cover the debt, couldn't a rational company just mothball the unused portions of the facility?
Explain what you mean.
Like, if you were only using 30% of the capacity, just shut down the cooling loops for the empty halls, power down the unused server racks, turn off the lights, lower your operating costs to match your new reality.
You can reduce your marginal operating costs by doing that, yes. The immediate electricity bill for the servers goes down.
But
Mothballing does not touch the fixed costs, and the fixed costs are the anchor.
the debt.
Even if a hall is entirely empty, you still owe the massive local property taxes. You still have to pay for 247 security for the entire perimeter.
The transmission lines connecting the facility to the grid still require constant expensive maintenance, regardless of how much power is flowing through them.
And if there is a dedicated gas plant attached to the facility, it still has to be fully staffed with highly trained engineers, because you can't just leave a gas turbine unattended.
So the physical footprint demands constant capital just to exist without decaying.
And this is where the political reality crashes into the financial reality again.
Because if a project is failing, the most economically rational thing to do is to admit failure, liquidate the assets, wipe out the equity, and clear the system.
But the political system fiercely resists admitting failure, especially on massive infrastructure projects.
Because canceling a project midstream carries catastrophic political optics.
Absolutely. If a project is canceled, the local construction unions lose hundreds of jobs overnight.
The promised tax revenues that the town council already budgeted for the new high school suddenly vanish.
The governor or the mayor who proudly cut the ribbon at the groundbreaking ceremony is suddenly the face of a massive boondoggle.
So the political survival instinct kicks in.
The local government will quietly extend tax abatements, desperate to keep the company from abandoning the site entirely.
The State Utilities Commission will find reasons to delay the required rate reviews just to keep the failure out of the headlines. They kick the can down the road.
They renegotiate terms in secret.
And this creates a situation where we might be trapping ourselves in the ultimate sunk cost fallacy.
By politically refusing to rip the Band-Aid off just to avoid the immediate optics of standing next to a billion-dollar white elephant, the system drags the failure out.
Are we causing more economic damage by dragging it out? I mean, does artificially prolonging the life of a structurally an unviable asset for 2 decades cause far more long-term damage to a community than just enduring a sharp, immediate crash?
It's a huge open question. We assume that because tech moves fast, its failures clear fast.
But the physical world absorbs failures like a sponge, holding on to the weight for years.
And that weight becomes even more profound when we introduce a factor that you simply cannot negotiate with.
Right. You can hire an army of lawyers to restructure a municipal bond. You can lobby politicians to subsidize a half-empty building. But there is one absolute constraint you cannot financialize, you cannot innovate your way out of, and you cannot negotiate with.
Water.
Water, the unfinancializable constraint.
Because the physical reality of computation is that it generates heat.
And managing that heat at a massive industrial scale requires water. Millions of liters of it every single day.
And let's look at the geographical paradox here.
Yeah.
Many of the most financially attractive locations for building massive data centers, places that offer vast tracts of cheap, flat land, favorable zoning, endless sun for solar,
are located in some of the hottest, most water-stressed, arid regions on the planet.
Arizona, parts of western Texas, the deserts of the Middle East, northern Chile.
These are regions where the water rights are already over-allocated.
The natural aquifers are slowly depleting.
The river systems are under immense ecological and agricultural strain. And into this highly fragile ecosystem, a tech company drops a gigawatt-scale AI data center.
A facility that requires roughly 5 million liters of water every single day just to run its evaporative cooling towers and keep the silicon from literally melting.
Which sets up this profound, deeply emotional conflict. On one side of the road, you have a multi-generational local farmer whose crops are dying because the water table has dropped too low for their wells to reach.
And on the other side of the road, you have a massive windowless concrete facility continuously vaporizing millions of liters of pristine groundwater into the desert sky.
It's terrible optics.
It creates a visual and political focal point for resource anxiety.
Now, the tech industry is very aware of this PR nightmare, right? If you read their sustainability reports, they're constantly highlighting their investments in incredible new cooling technologies.
Oh, absolutely. They heavily promote closed-loop cooling systems, which theoretically recycle the water.
They are pioneering liquid immersion cooling, where the actual server boards are submerged in specialized dielectric fluids to absorb the heat directly. Dry cooling radiators.
All of it.
So let me push back on this premise playfully for a moment and argue for the power of human ingenuity. Aren't we potentially underestimating human engineering here? Tech companies employ some of the smartest mechanical engineers on Earth.
Yeah.
Can't they just engineer their way out of the water problem entirely? Is this really a hard wall of physics?
It is a brilliant display of engineering, but they cannot cheat the fundamental laws of thermodynamics.
Because converting massive electricity into heat means that heat has to go somewhere.
Exactly. When you convert hundreds of megawatts of electrical energy into computation, the unavoidable byproduct is thermal energy. Heat.
Right.
That heat does not just disappear, it has to be moved from the microchip out of the building and dumped into the external environment.
And when the external environment is already a 110-degree desert.
Exactly. When ambient temperatures are that high, dry cooling becomes incredibly inefficient, sometimes drawing so much extra electricity just to run the massive fans that it defeats the entire purpose. Ultimately, at an industrial scale and a hot climate, the most effective way to move that massive amount of thermal energy into the atmosphere is through the phase change of water, evaporative cooling.
So even with better cooling, hot climates require massive water. Engineering can optimize the process, but thermodynamics always wins.
Always. And the optics of this reality are politically toxic. You have a massive tech corporation, often headquartered thousands of miles away, extracting a local communal resource.
So a chatbot can function.
Yes. The conflict between global utility and local survival becomes stark.
A tech economist could easily produce a spreadsheet proving that the data center generates vastly more GDP per liter of water consumed than the local alfalfa farm.
Economically, the data center is the highest and best use of the water.
But to a local voter or a municipal water board, that spreadsheet is irrelevant.
It is viewed as a visceral injustice. And that emotional reality drives immediate political action.
Permits get denied.
Expansions are blocked. Municipalities enact emergency ordinances blocking new data center hookups.
The costs rise astronomically as they are forced to negotiate massive community appeasement packages or construct pipelines to bring in gray water from distant treatment plants.
The entire physical build-out grinds to a halt under the weight of local political resistance.
How will local democracies weigh the abstract global value of an AI query against the highly local, tangible value of a residential water supply?
That is the open question. And as we established, when the physical build-out slows down, the financial models break.
Because the debt is still ticking, but the expansion is blocked by a local water board.
Right. So to bypass these incredibly fraught local battles over water and grid capacity, and to avoid the terrible environmental optics of burning massive amounts of natural gas.
The AI industry is attempting a radical pivot. They're turning to the ultimate clean baseload solution.
But in doing so, they are making the most irreversible physical bet of all.
The tech industry is going nuclear.
This represents one of the most fascinating and extreme strategic shifts in the entire AI narrative.
We're seeing it happen in real time. Microsoft buying power from a restarted 3 Mile Island.
Amazon buying a campus next to a nuclear plant. Google investing in small modular reactors, or SMRs.
China and the Gulf states building rapidly. The tech industry is literally attempting to drag the nuclear energy sector out of a decades-long hibernation.
Because the appeal is obvious. A nuclear plant provides massive, steady, clean power, completely independent of the weather, which is perfect for running AI models 24/7.
But the trade-off is time. Nuclear is a 100-plus year commitment.
Let's walk through that timeline, because it puts the speed of the tech industry into stark perspective.
First, you have the regulatory phase. Navigating the Nuclear Regulatory Commission to get the initial licenses and safety approvals takes an average of 5 to 10 years before you can even move a shovel of dirt.
Once you secure the permits, the actual physical construction takes another 5 to 10 years.
Assuming no major delays. So you are already 10 to 20 years deep before the first watt of electricity is generated.
Then the reactor is designed to operate continuously for 40 to 60 years.
And when it finally reaches the end of its life, you can't just walk away. The decommissioning process takes another 20 to 30 years.
And costs billions of dollars. And even after that, the spent nuclear fuel has to be managed for centuries.
So from the first permit application to the day the site is fully released, you are legally and physically bound to a process that spans over a century.
Now, we must place that century-long timeline alongside the life cycle of artificial intelligence.
Right. What happens if, in 10 years, the entire architecture of AI evolves away from these massive centralized training clusters?
If the tech industry's demand evaporates, you cannot just casually turn off a nuclear reactor.
You can't just lay off the staff and mothball the facility for a few years, hoping demand returns.
No. The physics of the reactor core, the incredibly rigid safety regulations, and the sheer economics of maintaining the specialized security staff absolutely prohibit it.
It runs or it goes through a multi-billion-dollar decommissioning process. There is no pause button. It's the ultimate lock-in. It's like getting a full back tattoo of a band you just heard on a streaming app yesterday.
That's exactly it.
You are permanently altering your physical reality for the rest of your life.
Yeah.
But what if they break up next week?
You're still walking around with a tattoo. And that tension presents a truly fascinating historical paradox for us to consider.
Which is?
A century from now, will historians look back at this AI-driven nuclear renaissance as a brilliant, incredibly lucky infrastructure play for humanity?
Like tech giants accidentally funded and built the clean, baseload power grid the world desperately needed.
Right. Or are we currently creating the most radioactive, hyper-expensive, stranded assets in human history?
For a technology that might be completely decentralized in a decade. There is no correct answer, but the stakes are fascinating.
And this nuclear paradox brings us to the very core friction underlying everything we've explored today.
The fundamental issue of time. There are 3 different clocks running in this AI boom, and they are completely out of sync.
This concept of the temporal mismatch is the structural engine driving the entire priority 3 dilemma.
Let's lay them out. The first clock is the technology clock,
Which is blazingly fast.
It evolves monthly. A frontier model today is a commodity in 18 months. Hardware is obsolete in 3 years. Use cases mutate constantly.
The second clock is the financial clock, which operates on a medium time frame. Venture capital, corporate capex, debt covenants.
That clock typically runs on a 3 to 7 year horizon.
It is fast enough to create intense urgency, but just slow enough to firmly lock the money in.
And finally, the physical clock. The real world, it is agonizingly slow.
High voltage transmission lines, gas turbines, nuclear plants. They operate on 25 to 40+ year lifespans.
So what does this all mean for you? We have hardware living in the decades, money living in the years, and software living in the months.
The terrifying mismatch is that the 40-year physical infrastructure will mathematically outlast the technology it was custom built for.
It will outlast the 5-year financial debt structures. It will consume, and service debt long after the initial AI hype has faded.
Can a global economy survive when its three primary gears are turning at such drastically different speeds?
Yeah.
How does the system not strip its own gears?
We've been looking entirely at the Western approach so far, which is greenfield, meaning building from scratch.
Right. Pouring new concrete.
But the sources highlight a totally different strategy happening in the East that flips this entire paradigm on its head. Let's talk about the asymmetry.
When we observe the AI infrastructure strategy in China, it looks fundamentally different. They are utilizing regions with existing excess power capacity.
Like Guizhou or Inner Mongolia, regions built for industrialization that shifted or didn't fully materialize.
Exactly. They rely on existing coal and hydro. The power generation is already there. The turbines are spinning.
So it is an incremental load, not a greenfield build-out.
They aren't initiating a massive build-out that requires 10 years of permitting and new debt. The marginal cost of powering their compute is incredibly low.
And Eastern labs are achieving competitive AI with asset-light approaches.
Open-weight models, last-gen GPUs, and distributed inference in secondary cities.
This completely challenges the bigger's better narrative we hear every day out of Silicon Valley.
The Western thesis relies entirely on the assumption that massive scale provides a competitive moat. But in a commodity market, asset-light beats asset-heavy.
Because the asset-light player can pivot and adapt.
The asset-heavy Western player is locked into their massive fixed costs.
So if the West builds a $300 billion cathedral, and the East runs a chapel out of a shipping container using leftover electricity, and the market decides it only wants a chapel, does the West's massive infrastructure advantage actually become its fatal flaw?
It's a profound strategic vulnerability. The Western physical moat might just be a moat around their own astronomical cost structure.
What if the winning strategy for the next decade isn't achieving maximum computational scale, but maintaining maximum physical flexibility?
The East appears to be strategically betting on flexibility, while the West is aggressively pouring unalterable concrete.
Which brings us to the ultimate, most explosive question of priority 3. When the cathedral sits half empty, someone still has to pay the bishop. Who bears the cost of this physical lock-in?
In a purely financial correction, the wealthy bear the cost. VCs, equity holders, tech investors. The loss is concentrated.
But in a physical correction, the cost is socialized and borne by everyone.
It hits the ratepayer, whose power bill spikes to cover an underused gas turbine.
It hits the taxpayer, whose local government is servicing municipal debt for a half-empty server farm.
It hits the farmer with no water.
This is highly regressive. It hits the poor the hardest, as they spend a larger share of income on energy and water and live closer to the environmental externalities.
And this is politically explosive. When voters realize the benefits accrued to a few capital owners, but the costs were socialized to their utility bills, the political system will retaliate.
Big tech will become a target, exactly like big oil or big pharma. Not because the tech is bad, but because the distribution of costs is unjust.
This backlash will take the form of permit denials, antitrust actions, and rate case rejections.
Which slows the build-out and feeds right back into crushing the financial models.
How can societies distribute the physical costs of AI more equitably before this social contract breaks?
This is the human element that gets lost in the spreadsheets. If the promise of AI was to democratize knowledge, but the physical reality is that it just raises the utility bills for a single parent so a hedge fund can run algorithms. The political backlash is going to be legendary.
We have covered an immense amount of ground today.
We really have. We started with an invisible cloud and ended with a sprawling global footprint of concrete, tapped aquifers, and nuclear gambits.
We've seen how financial clocks and physical clocks are wildly out of sync, and how the asset-heavy Western approach is a massive gamble compared to asset-light alternatives.
I want to leave you with a final thought to mull over. We've spent this entire time talking about how the physical world constrains the AI software. But if AI truly becomes as capable as its creator's project, could the AI itself eventually be used to solve the very thermodynamic, engineering, and grid distribution problems its own existence is creating?
A super intelligent model figuring out how to perfectly route electricity or design a radically efficient cooling system.
Exactly. Or will it be too late because the concrete is already poured and the debt is locked in?
A race between digital optimization and physical degradation.
And the wildest part is that this only covers priority 3. If this deep dive was about the physical infrastructure, what happens when this correction hits the labor markets, the cognitive workers, and the social contract itself?
That is priority 4, a whole other layer to unpack next time.
Thank you for joining us on this deep dive today. Remember, in a world moving this fast, the best way to prepare for the future is to keep questioning the heavy, physical reality hiding beneath the digital hype.